Coming into the 2013 paper, question number 37. A Sri Lankan firm exports 10 million worth of tires to a company in the UK. According to the double entry accounting system, which two parts of the BOP will be affected? Remember, I have told you all a very easy method to get this done. First, what do we look at? First thing, is Sri Lanka getting money or paying money? Tell me, are we getting money or paying money? Sri Lankan firm, manufacturing firm, exports 10 million worth of tires to a company in the UK. Are we getting or paying? Sri Lanka is getting money. So whenever we are getting money, what is the double entry? When we are getting money, debit, financial account, debit, financial account, other investment, currency and deposits. That's the, if we are paying money, then credit, financial account, other investment, currency and deposits. So then tell me, this Sri Lankan manufacturing firm, tires, where does tires go? Exports of tires, tangible good. Where does that go? Tangible goods, think current account, this one, break down and see. Where does it go? It goes in our current account. What is a sub account? In my current account, it goes under my trade account or my goods account. If you want to be very specific. So you can say current account, trade account. It's exports. So which one is our answer, Lamai? No, so if money is flowing into your country, then debit, financial account, currency and deposits. Money flowing out is credit. So yes. Right. Which one is our answer, Amai? Exports in the current account. So money is flowing in. Our exports are credited. Financial account is debited. Okay. Yes. Don't mess up the basics. I've taught you all the basics. Please don't get that confused. I don't know how other teachers put this. So whenever Sri Lanka is getting money, the double entry is debit, financial account, currency and deposits. You can say financial account, reserve account, currency and deposits, financial account, other investment account, that doesn't matter. Financial account, currency and deposits. When we are getting money. If we are paying money, credit, financial account, currency and deposits. So think of this financial account, currency and deposits like your cash book. If you all are doing accounting, think of it like your cash book. Whenever you get money, cash book debit. Whenever you pay money, cash book credit. Have that in mind. So, apart from donations and all, everything else involves cash. So, 95% of double entry, if you can figure it out that way. I'm not going to teach you double entry now. Hoping you all remember those. Okay? Now, so which one is our answer? Am I quickly tell me? Foreign reserve assets and foreign reserves. Yes. Can we go with number 3? Yeah, no? Yeah. Exports in the current account, reserve assets in the finance. The financial account, other reserves, currency and deposits. 5. Non-residents, exports in the current account, claims on non-residents in the financial account. I don't think. Answer scheme says 5. Marking scheme says 2013 question 37. Can someone check? Can't say 5, right? Claims on non-residents foreigner, that's something else. 3, no? Check your password book, would have made a mistake. Okay. So 3 has to be the correct answer. I don't know, maybe certain password books say 5. It has to be number 3. Okay. Then go into 38. The Department of Statistics of a country wishes to present its final balance of payment account. It has calculated the current account balance, capital account balance, and the financial account balance. The additional information required to complete the task. What's the missing one? When you're getting your BOP balance, current account, financial account, capital account, there is another small thing missing. What is that? That is your errors and omissions. So there can be a lot of errors and omissions. You put all of that there. Have that in mind. So usually your BOP is the current, capital, and finance. Those are the main things. But also there can be certain errors and omissions. That is the missing one over here. Okay, just have that in mind. Then going into 39. This also we would have done in unit number 9. It's a unit number 9 question. But since I have put this in the unit 10 PDF, we will do. A country's terms of trade currently stands at 150. So TOT is 150. Since 2010, now remember Lamai, how do you calculate TOT? This is commodity terms of trade. That is your export price index. Export price index divided by your import price index into 100. That's how you have things. DCS has given a car to our place, said that there'll be a statistic collection. Yes, most likely should be for that. If they do the collection, the date report will come out not very soon. It will take some time. No, we don't put the volume here, Lamai. Volume, you put it in the income terms of trade. So when they say terms of trade in general, I have told you all, that means commodity terms of trade. Connection is lagging. Okay, I'll have the camera off. Okay. So they are saying the terms of trade is 150. And they are saying since 2010, the average price the country has received through exports has increased by 20%. So that means how much is my export price index now? How much should my export price index be? In the base year, export price index is 100. Now it has increased by 20% means now it has to be 120. And they're asking you what would have happened to import prices. So can you work around and tell me how much is my import price index? Do the maths and tell me. How much is my import price index? 150 is equal to 120 divided by import price index into this. Do I get 80? How much do you get? So you get, when you work things around Lamai, you get import price index equals 80. Now, is that our answer? Is that our answer? No. They are asking you by what percentage it would have fallen by. In the base year, import price index is 100. Now, when we calculated, we got import price index 80. So it has fallen by how many percent? Your import prices would have fallen by a 20%. Yeah, this is a very common question. We did all of this in unit number 9, okay? I'm not going into detail because this is a unit 9 area. I have mistakenly put it here, so I'm discussing without just throwing it away. Okay. Then question number 40. This is the easiest, I will say. Assume that a basket of goods cost $120 in the United States. Same basket of goods cost 9,600 in Sri Lanka. What is the purchasing power parity exchange rate now? Something worth $120 is worth 9,600 in Sri Lanka. Then something worth $1 is worth how much now? Come on. 9,600 divided by 120. 9,600 divided by 120, we get 80. What does that mean? That means my purchasing power parity exchange rate is 80 rupees per dollar. One of the easiest questions that you can ever get. PPP, other way, what is the other way? This is the main way, Lamai. You look at this. Yeah, so this is in dollars. So exchange rate is for per dollar, it is 80. You don't give it the other way. You don't say per rupee it's this much. You don't usually say that. Okay. Then 41. What about this? Foreign direct investments in developing economies is likely to result in. Now, let's say Sri Lanka is getting a lot of foreign direct investments. Let's say Apple is coming and starting a factory in Sri Lanka, Nike is starting a factory in Sri Lanka, right? Everyone is coming and investing in Sri Lanka. So as a result, what will happen, Lamai? First one, a reduction in local wage level. What will happen to local wages, Lamai? Let's say if Nike comes and starts a factory in Sri Lanka. If Nike comes and starts, Lamai, you know what will happen? Everyone will want to work in Nike, no? Everyone will want to work in Nike. No one wants to work for a what? No one wants to work for a small shoe company in Sri Lanka. So then what happens? If the small shoe companies want to get more and more people, what will they do? They will have to increase their salary. Otherwise, no one will come and work for them, no? So there won't be a reduction in local wages. There will be a increase in local wages. First is wrong. Second one, reduction in tax revenues? Not really, Lama. You might not get as tax revenue as you expected, but that doesn't mean tax revenue will come down. So when these foreign companies comes and starts factories and all, you might give them like tax holidays, you might do those stuff, but still you will get some sort of tax, Lama. So you can't say there is a reduction. Second one is also wrong. Corporative tax, no, the percentages have not changed. Then Lamai, can you tell the third one is correct? What about the third one? Reduction in the range of consumer goods available. Is that correct? No, no. If Nike and all of them come and start factories, there won't be a reduction, there will be more and more consumer goods. Expected amount of tax can't be charged. Yes, that is correct. You will not get taxes as much as you expect. But that doesn't mean you get less taxes. So number two and what you're saying is different. When there are foreign direct investments, you might not earn as much as you expected from them. But that doesn't mean you're earning. There is a reduction in tax. Don't get that confused. For example, you expected to get 100 million as tax revenue from these people, but you're only getting, let's say, 50 million. So you're getting 50 million. You're not getting as much as you expected. So you can't say that that is a reduction in tax revenue. Okay. Then fourth one, Lamai, worsening in the net foreign income flows from investment. Can that be the answer? That can be our answer, no? Why? Whenever there is foreign direct investment, do you think, Lamai, those people keep the profits and all that they get in our country? If Nike comes and earns a profit and start businesses here, what will they do? They will send out money, no? Dividends will go out. So dividends is net primary income. They will send out their profits back to their home country, USA. So dividends, profits, all of that will flow out. So that can worsen your net foreign income flows. That can be your answer. Fifth one says worsening of the capital account. No, your capital account doesn't really worsen. It doesn't even involve your capital account. Okay. Yes, when paying royalties and all, yes, it can worsen, but foreign direct investment is not a royalty. Foreign direct investment is you coming and starting like a factory. Worsening means getting bad, Lamai. Advantage of having them here, one is direct money coming in. No? When these people come and start their factories in Sri Lanka, that's a huge amount of investment coming into Sri Lanka. So now, I would have not talked about this much with you all, but Sri Lanka is looking at a lot of new foreign direct investments, especially for the renewable energy sector. We are going to get a lot of different investments from different people. Royalties, Lamai, that is for like McDonald's and stuff, franchises. That's royalty. Reduction in the range of consumer goods? No. Now, consumer goods, for example, when more businesses come and start in Sri Lanka, Lamai, there will be more consumer goods. Now, for example, if Nike starts a factory in Sri Lanka, now you have Nike shoes also in Sri Lanka. There is an increase in the range of consumer. So, those are the options. Okay. Right. See, how did you all do so far in the 2013? There were 1, 2, 3, 4, 5. How much out of 5? 2013 is a little bit usually a harder paper. At least 3. Yes.